Hi, everyone. Welcome to Your Money Matters. I am Angela Giroux. It is good to be back, let me tell you, because we got a good one in store for you today. Of course, you're going to get expert insight from Ted Bauman and Clint Lee. You're going to get some ticker symbols, so make sure you grab a pen and a piece of paper. We're going to talk inflation. Like I said, it's going to be a good one. Stay tuned all the way through. Make sure that you do. But before we get started, a couple things. For one thing, I want to make sure that you fellas haven't been slacking while I was gone and that everybody knows that Clint just launched a new research service. It's called Slingshot Profits. I mean, he back tested this thing. He beta tested it. We rolled it out to a small group of subscribers and the results have been astonishing. So make sure you click the link above. You'll take a look at some of those results. You get more details. Make sure that you do. Now, Ted and Clint, you know that I'm a girl that loves a good theme. So we're not going to do a t-shirt contest this time, but we would love to hear from those of you watching. What do you think of our Halloween t-shirts? I'm just going to say this. I'm not trying to sway anybody, but Ted only has one villain on his, just about all of them. So take that for what it's worth.
Yeah. Okay. Well, we'll see. We'll see if there's safety in numbers. Huh?
But speaking of scary, we are going to talk about inflation, and it's something that people haven't been talking about as much. You know, it's all over the news and the tip of everybody's tongue, inflation. Now we haven't been hearing about it as much, and we haven't been hearing about dreaded stagflation. Now, of course, it's impossible to tell what the future holds, but the Federal Reserve keeps telling us that this inflation is going to be transitory. But here's my question. I'm going to start with you, Clint. What if it isn't, and how do we prepare for that?
The first thing I want to highlight is that I was so upset and disappointed with the last T-shirt contest that I decided to drop out and didn't participate in this one. No, I think with whether it's inflation with no growth being stagflation, I think the one thing you want to do first is start to look at sort of what market-based expectations of what's going on and where things could go. So I think where you've really seen inflation show up from an asset market standpoint is in fixed income with yields, especially with treasury yields. And so here's a chart just to show where yields started the year and where they're at right now. So the blue line is the U.S. Treasury yield curve in January versus the orange line is where we are now. So this just plots out, for the various maturities listed below, from a 1 month all the way over to all the way out to the 30-year, what the yield on these are. And what you can see is that pretty much 1 year in, you have not seen any movement in interest rates, very, very minimal. But once you start to go more than a year out, you've seen a pretty decent sized jump across the entire curve. And so that speaks to a couple things that I'll get to in just a minute, so you can see what's influencing that and where that can go. But the next thing you want to do is, when you're looking at this yield curve, you want to compare the yield on a longer term security to a shorter term security and where that stands relative to history. And so the next chart I have shows the 10-year treasury yield minus the 3-month plotted out all the way back to the early 1980s. So here's what that chart looks like. One thing I find interesting is that going all the way back to the early 1980s, you can see that this line, that yield spread, trades in a fairly consistent range. You see us every now and then we dip below zero. That's the black line on here. The yield curve goes inverted, and usually to the tune of 0.5% down to about -1%. But then on the high end, you see the yield curve historically has topped out around 3.5% to 4%. And so if you look all the way at the right-hand side where we are right now, we're right about 1.75% on this spread, and we could still most certainly see much higher levels. And there's a couple reasons for that. One, we talked about how the short end hasn't gone anywhere. Well, it doesn't look like it's going to go anywhere for at least a year now. So the next chart I have shows what markets are pricing in terms of what different central banks are going to do with short-term interest rates. So I know it looks like there's a lot going on in this chart, but really the three bars you want to pay attention to is the black one is the Fed, the red bar is the European Central Bank, and the gray is the Bank of England. And what this does, just looking out into the end of next year, it's projecting, it's what the market's projecting where each one of these central banks is going to have short-term interest rates. And so the one thing I want to highlight is that you don't get until September of 2022 until you start to see the market pricing in the first full interest rate hike for the Fed. So that black bar increasing to about 0.25%, that 25 basis points. So it's not until September 2022, a year from now, that we're starting to see the first interest rate hike. So rates on the short end are going to continue to be held at extremely low levels. Meanwhile, there's a couple things going on with longer term yields. You know, the one thing we have coming up is the Fed's expected to start ending its quantitative easing program. So I mean, that removes a huge source of demand for Treasury securities, especially on the longer end of the yield curve. Now, the other thing you got going on, just going back to these inflation concerns, that they are not going away. So the last chart I have here shows what's called the 5-year break-even rate. So what this does is it takes and compares a normal Treasury security to one that's inflation protected. The difference between the two is what the market is implying inflation to be looking out. So you see this plotted over time. You look just more recently, you can see we had this big jump in that market implied level of inflation. Now we're starting to break above sort of this 3% threshold that had capped this level going back for quite some time. So we start to see this move over 3%. That means you're still seeing all these inflation fears at the same time. The Fed's holding rates steady on the short end. So that's why you could continue to see the yield curve steepening here.
Now, Ted, I'm going to ask you a question real quick, but first, Clint, going back to that chart you just showed, what the heck is that yellow line?
Which one? The one that we were just on?
The yellow one that goes all the way across.
Those are the Kiwis. The Kiwi.
Okay.
The Reserve Bank of New Zealand. We were talking about that earlier today. I was wondering, what is it about the New Zealand that they're tight with their money, I guess.
I guess so. Whoa.
They're ahead of the curve.
Ahead of the curve. Yeah.
Now, Ted, you do know about these things. You are an economic historian. And some people are arguing that we should look to the 1970s, that period of stagflation, as a guide. But what do you think?
Well, let's look at a chart just so we know what stagflation means. This chart shows the year-on-year change in the U.S. CPI, Consumer Price Index, during the period from really the mid 70s until the early 80s versus the blue line, which is the manufacturing index, the main one for the United States. And so what you're seeing is a lot of inflation, but you're also seeing a decline in economic activity. Usually those things move in tandem. In other words, you'd expect to see less inflation when the economy is slowing. And so stagflation is when you get a drop in economic activity combined with higher prices. Now, over on the right-hand side, far right-hand side, you can see that we're now in a situation where economic activity as measured by manufacturing is down, but inflation is back up again. We haven't really seen that happening since, I guess, there was a little bit of that in the late 90s. And I just want to emphasize here that this was a formative experience for so many people, particularly policymakers. That red rectangle there, that is when their fear of inflation was sparked. Now, if you look at a long-term chart, which I don't have, but if you look at it, that episode was a tremendous outlier in global financial history. It never happened before to that extent. It's never happened since. But still, a lot of people want to say, well, that's how you should interpret what's going to happen. In fact, there was an article from Market Watch that Clint shared with me this morning saying, buy gold and energy stocks because they were the best performers during that period. But the problem is that if you actually look at what was going on at the time, you neglect the actual history. One was that President Nixon abandoned the convertibility of gold from the US dollar, which drove up the dollar price of gold dramatically. And then you had the Arab oil embargoes, which were good for energy companies because, they ride on the back of higher prices. So here's a chart that shows what happened during that 70s period. And, you can see that gold was the outlier, but you also saw, reasonable growth in US value stocks, commodities, and so on. So it wasn't a complete write-off, but it definitely wasn't good for growth. and it wasn't good for bonds. No surprise there. So I'm just saying that if you're going to look at the 1970s, you got to look at not just the inflation figures, but what actually drove those inflation. And it was very much a supply side shock combined with, an unprecedented move on the monetary front. Now, historically, a steepening yield curve is associated with strong economic growth, right? Now, I want people to be careful about using that as a guideline now for two reasons. So in other words, if you see the steepening yield curve, it normally means we're headed for strong growth. That's what the market's pricing in, but be careful. First, there's a bit of a cause and effect problem with yield curves. I mean, in the past, the yield curve normally steepens because bond markets think central banks will raise interest rates to prevent economic overheating and inflation. So it means that steepening is associated with expectations of strong growth. But that's not the case right now. We've seen right across the board, lots of the major banks have dialed back their predictions for global and US growth over the next couple of years. So that means that the inflation expectations are not caused by too much growth. It's caused by supply shocks, just like in the 70s, right? Now, what happens if you raise interest rates moving into a declining economy? It's what they call a policy error, which could lead to a damaging recession, just like what happened in the late 70s, early 80s. Arguably, it destroyed Jimmy Carter's presidency and led to Ronald Reagan, that whole tightening into a downturn. My point is central banks know this. They've learned from history. They're unlikely to repeat that scenario. So that's one thing to be aware of. The second thing is that we are in an historically unprecedented situation. We've never had central bank activity like we have for the last decade and more. We have super liquidity. Here's a chart that shows central bank asset purchases since Lehman went bankrupt back in the day in 2008. I mean, just look at that. I mean, that's unprecedented. We've never seen anything like it. The only antecedent would have been the Bank of Japan, which was already trying to do this prior to the great financial crisis because they had their own asset collapse during the 80s. But right now, there's a lot of money out there. And so what happens is if you start seeing banks withdrawing liquidity from markets at the same time as raising short-term interest rates, perhaps to try to choke off inflation, which is not caused by excessive demand, it's caused by deficient supply, you could have a pretty bad recession. Now, does anybody want that? I don't think so. So my feeling is that we could see stagflation, but if it is, it's not going to be as long-term as we saw in the 70s. But if it happens, there's ways you can play it.
Well, what is our best bet if we have inflation or, God forbid, stagflation?
Well, that chart that I showed you earlier showed that, commodities, for example, did well during the 70s, and some defensive stocks and some value stocks, which tend to be in the cyclical space, in other words, consumer facing. But, that's where the cause and effect come in, because if inflation is supply driven, in other words, microchip shortages, energy shortages, shipping problems, all of that, then if the yield curve steepens, it doesn't mean that those stocks are going to do well. It means that they're raising interest rates in order to combat an inflation problem that is not caused by money. It's not caused by demand. It's caused by supply. So I believe that despite the fact that a steepening yield curve often means that you should buy cyclicals, in other words, companies that sell during economic growth, I don't think you'd want to do that right now. I think because we could actually be causing a recession if they do raise rates. But there is a way to play this, and that is given the huge expansion of credit over the last decade. Here's the opportunity. Here's a chart that shows growth in global credit balances and as a percentage of world GDP. And clearly, since the great financial crisis, there has been a dramatic increase in the amount of debt. Now, a lot of that debt is floating rate, which means that you can adjust the interest payments on those debts based on benchmark rates like the Fed. So that means that if you look for stocks that can benefit when the spread between short-term and long-term rates increases, you could make some money there. And I believe Clint has some ideas about where we could do that.
Let's hear them.
Yeah, well, look, if we continue to see the yield curve steepening, like we were talking about earlier, one of the direct beneficiaries of that is going to be financials. There's a couple of things going on with banks right now. One is, with the improving economy that we've had up to this point, all that money they set aside for loan loss reserves, they're coming back onto their income statements. That helps boost profits. But then the other thing is that as you get a steepening yield curve, that directly benefits banks' net interest margin. So basically, a bank's making money by borrowing short and lending long, and they're keeping the difference between the two. So as the yield curve steepens, that helps pad their profit margins. And there's still a lot of value there. So I want to show one chart that shows the relative performance of the financials ETF XLF compared to SPY. So here's that chart. This goes back to just after the tech bubble. You see the collapse in this ratio during the financial crisis. So that's just the banks just getting pummeled and underperforming the S&P. But look at what's happened since then. This line, it's had some ups and downs, but just really hasn't gone anywhere since that time. Just been trading kind of sideways. And this catalyst with the yield curve right now could be a key one to finally see this line, the outperformance of financials, really start to take off. There's a couple other securities to think about as well. One area that I would like, just with the general rising interest rates, is in floating rate securities. That, especially if you're a fixed income investor, if you have a longer duration profile, it means you're more sensitive to the changes in interest rates. Rising rates can hurt you there. Floating rate debt has a very low duration. The one thing you got to watch out for is there's a lot of high yield companies in there, junk companies. So, if economic conditions start to deteriorate, that's something to be aware of. But the one I in particular had in mind is ticker FRA. It's a BlackRock floating rate strategies fund. You can get a 5.87% yield on that one right now. And then Ted, do you have a couple other ones?
Yeah, I do, and I think it's basically the same strategy. What you're trying to do is to get ahead of the likelihood that the financial sector is going to increase profits and earnings and probably increase their dividends because of this increasing gap between their cost of borrowing money and what they can lend it for. So I like two. I like one called JPS. That is the Nuveen Preferred Securities Income Fund. It includes preferred shares, but also some other types of bonds, convertible bonds, and so on. So this is an 85% of that is actually investment grade. So it's very safe. Unlike, Clint was just mentioning, be careful of investing in junk bonds, because yes, some of those companies will take a hit. But it's also diversified. It's also about half of its investments are non-US. And right now it gives you a 6.2% yield, which is great. The other one I like is PTY, which is the PIMCO Corporate and Income Opportunity Fund, a yield of 8.7%. It's a little, the risk profile is a little higher, but again, it's positioning you to benefit not just from this high yield, but if we do see a reversion to, the pre-2008 situation with respect to financials, where they were much more highly valued, then you could also get, growth in the price of these assets as well as the dividends, and you can lock in a great dividend yield right now.
All right, so there you have it, folks. You've got JPS, PTY, and FRA are ways that you can play this. Again, we'd love to hear from you, so please comment below. Let us know how big of a party pooper you think Clint is that he didn't wear a Halloween t-shirt today. And he may be a party pooper, but this guy knows his stuff. So make sure you check out Slingshot Profits. Thank you so much for watching. We'll see you next week.
Thank you.